Thanks very much for having me. So I will be talking in a Russian version of English. Hopefully Len will translate it into proper English. And so with that, I'm going to talk about non-GAAP metrics and proliferation of non-GAAP metrics. And I think we are, by virtue of what I'm doing, we are well positioned to observe what's going on because I'm an analyst in essence. So I analyze companies and then write a report, buy or sell a stock, okay? And so we deal with a lot of institutional clients who are obviously, we have roughly 40 large institutional clients in Canada and around 20 large hedge funds in the United States. And so what I will be talking to you about, I'm going to talk a little bit about Veritas, the state of the non-GAAP, why non-GAAP is important, usefulness of non-GAAP, and common non-GAAP adjustments that we see in our practice, and then some recommendations. So, just like in YouTube commercials, right, there's going to be a little commercial about Veritas, which unfortunately we cannot skip. So I'm going to try to do it fast, and then we'll move to the rest of the presentation. So what is Veritas? We have been doing equity research since 1999, and it started from forensic accounting practice. And we are an independent firm, so we are not owned by any bank. We don't do any advisory services for companies that we cover. We don't do any investment banking. And so we are employee-owned. I'm I'm one of the owners of the company. And we try to tell the truth, not what management or what the market wants to hear. And so one thing that we don't do is we don't cheerlead. And unfortunately, what's been going on in the investment community and in particular in sell-side research for a long period of time is that, and it's evidenced by virtue of having roughly 90% of recommendation being either a strong buy or a hold, which just simply cannot exist, really. Okay, so unfortunately, there's been some cheerleading going on. And so a couple of examples of things that we do differently. So I'm not sure how many of you have heard of Valeant Pharmaceuticals, but at some point in time, it used to be the largest Canadian public company, believe it or not, larger than Royal Bank of Canada. It's a pharmaceuticals company, so they sell drugs. They don't really develop much of them. It was a growth by acquisition story, and we've covered them starting in December 2011. Originally, we issued all sorts of accounting alerts, which is a series of reports that we publish when we see things that worry us in terms of accounting, when we see issues with management, when we see all sorts of changes in disclosure and aggressive accounting. And so, but we thought the story can keep on going. And so then in 2014, we put a sell recommendation on this stock. And I lived through that period because I was covering it. And then the stock doubled on me in the course of a year, okay? And everybody had a massive buy on this company. They did a lot of investment banking, so obviously all the sell-side analysts had huge buys on them because of all sorts of relationships that large banks would have with Valeant, or at least in part. And so, and then of course the stock started to collapse, and it lost 95% of its market capitalization. And so we are not afraid to make tough calls and for good or for bad. Here's another example, Yellow Pages. So the analysis that we do is we try to, and I'm going to discuss about that later, try to corroborate the story that management is putting out there. And so with the Yellow Pages, everything seemed great back in the day. Revenues were growing up, but what we discovered is we actually went and did the count of the Yellow Pages. We selected the Yellow Pages books, that was back in 2006, and counted the number of ads that they have there. And we concluded that volumes are going down. There is customers are moving to Google and to internet and doing searches through internet. And we don't see it on the revenues yet because Yellow Pages have been raising prices. Okay, and so we got a lot of backlash from the other analyst community. The company, of course, wasn't happy. And then ultimately the stock dropped quite significantly since then. So this is our track record in terms of our buy recommendations and sell recommendations versus the index, being the TSX S&P index. The other thing that worth mentioning is oftentimes what we as analysts who analyze financial statements and who ultimately write research about companies, what we tend to focus often is the story. And the story is like a commercial that a company puts out there. And oftentimes what happens is that commercial is much more beautiful than the actual product once you buy it and you start using it. And then what's happening on the market is you have this story, and then it's being magnified by experts who say that, yeah, this is great company, you know, what they're doing is beautiful, they are trying to re-engineer the entire industry, you know. Then there is misperception about what auditors are doing, and so for some reason, a large chunk of investors believe that if companies have clean audited financial statements, therefore the story is also corroborated, if you will, which is not, of course, always the case, because the story oftentimes differs from financial statements. And then there is underwriters, and there are analysts, and then analysts. There is big cheerleading, and in the process, facts are often being ignored and, unfortunately, outweighed by the hype of the story. Okay. So here are some of the infamous blow-ups that happened, and you could see we caught all of those that happened in Canada. And in the process, unfortunately, we also had to lose some clients. It's tough to go against the consensus. And I remember when I was covering Valiant, I would get emails that I'm costing my clients basis points, that, you know, my research is quote unquote in research. You know, my colleague Anthony was getting emails saying you got to rein in your boy. He's way too tough on Valiant. I kid you not. And so all of these things happening, and it becomes really, you know, it can become pretty intense. But at the very least, one thing that we're proud of is we detect the bombs ahead of time, and that saves ultimately our clients money. And this is some of the, in terms of the top 10 worst performance in any given year on the S&P TSX 60 that we warned ahead of time. So now, with all that background, I want to talk about some of the interesting aspects from recent studies that's been going on. And so there was a study by CFA together with the Accounting Standards Board and CPAB, and they surveyed institutional investors and sell-side research firms that cover companies, and in order to understand how do they perceive audit. And so, of course, people found audit highly relevant. But what was lacking is the detailed knowledge and understanding of the scope of the audit and what it actually does. Okay. The other thing that came out is that investors use a variety of information, a wide variety of information, to make their investment decision. And while audited financial statements are fundamental, decisions are increasingly based on unaudited financial statements, and unaudited information, period, which is where the non-GAAP metrics also come into play. And you could see that only less than 20% of the information that investors are using for their decision-making is based on audited results, okay? So what are the different types of GAAP as well as non-GAAP financial as well as non-financial metrics? So of course there is GAAP KPIs, okay, such as EPS, and there is a certain way how they should be calculated. There is GAAP, so there is standardization, okay, be it GAAP or IFRS, and of course they are verified, right? So there is external audit. And then there is non-GAAP metrics, financial KPIs such as EPS, non-GAAP EPS, adjusted EBITDA, free cash flow. Now, there is certain guidance related how those should be presented and prepared, but this is not audited, really. This is not, so companies have a lot of latitude how to put together those metrics, and they can change them at will. And while there is some assurance around them, but it's very little, okay? And then there is other financial KPIs such as average revenue per unit, per user, there is same-store sales, which is all prepared by management. There is operating KPIs such as churn, barrels, subscribers, etc. And of course, management prepares all of those, and there is very little assurance work, probably for a good reason, done on them. And so, going back to the survey, what do the users value? And not just people like me who have, or other sell-side analysts who value companies, but also the investors, the portfolio managers who manage large funds. So they definitely value dialogue with standard setters, okay? They value reliability, consistency, comparability, and transparency of non-GAAP metrics. And that's very important for them. And recently, CPAP did a very good work by coming up with essentially a guideline or a checklist for audit committees to consider when they are overseeing preparation of key non-GAAP metrics. So this is all good steps in the right direction. Now, what do you think are most used financial metrics for investment decisions? Anybody want to take a guess? What do investors use the most? Okay, anything else? EPS. GAAP or non-GAAP? Non-GAAP. Anything else?
Adjusted EBITDA.
Adjusted, beautiful. Okay, excellent. So EBITDA, okay? Free cash flow in that same order. And then EPS, of course, adjusted. None of them are GAAP, okay? All of them is, you know, it's not even EBITDA. It's really adjusted EBITDA, to your point, because on top of that, there's a bunch of other adjustments. And this is the study that we did together with PwC, and then we essentially reconfirmed all those same points back in 2015. So, of course, these are all non-GAAP metrics, right? Non-GAAP KPIs. And so, but then, of course, they are susceptible to manipulation, they have issues, but they serve very important purpose in that they bridge the gap between IFRS-based financial statements, which is past-looking, okay, and the essential questions that investors need to answer. That is, what is the sustainable level of earnings, cash flows, etc., going forward? Because past is all interesting, but what I'm really buying is the future, right? And so that's where non-GAAP metrics come into play. So that's one of the key positive benefits that they provide. And of course, the other benefit is they give you an easy way out. Essentially, management tells you, here's the thing you got to be looking at. So we're making your life easier. And if you are an analyst and you're covering 20 different stocks, and if you are a portfolio manager and you have 90 different stocks that you oversee, there is no way you're going to be going into the financial statements. You're not going to be reading the notes. You're not going to be even reading most of the MD&A either, right? And so what you need is a couple of numerical KPIs, both financial as well as perhaps as non-financial, okay, that help you corroborate the story and see whether the story still works. And so I mentioned, here is one of the key questions that we need to answer as investors, right? Is the sustainable level of earnings. And why that is important? Because our job as analysts, but also as investors, is to evaluate companies' performance, right? And what's important is to distinguish between business innovation, so in other words, business progress, okay? Good business strategy, be it organic or through acquisitions, and accounting innovation, right? And of course, the difference is that business innovations equals higher earnings going forward, higher free cash flow, right? Equals multiple expansion, so higher stock price, and of course accounting innovation is not sustainable, right? So, and that's where, and the problem unfortunately that happens with the non-GAAP metrics is they sometimes tend to get abused, and companies end up doing a lot of accounting innovation, okay? And so just to illustrate a couple of interesting examples. So this is Valiant going back all the way to 2011 and early 2012. And so you could see this is one of the key metrics that they used to provide, which is called organic revenue growth, okay? So they used to calculate that organic revenue, and it's a company that was buying, you know, that was making acquisitions almost on a quarterly basis. So that's why organic revenue growth really mattered for investors to understand how is the kind of base business doing. So they started the year with a certain way they would calculate that metric. And then in Q2, they changed it, all right? And then you see there is this yellow bar, which is essentially our estimate back at the day of what would organic revenue growth have been had they maintained the same methodology of calculating organic revenue growth rate, okay? Then they changed it in the third quarter. They changed it the third time around, okay? And you could see each time they would make the change, it would inflate the reported organic revenue growth, right? So here is an example of accounting innovation, which of course is not sustainable. Here's another one. This is HMHC. It's a publishing company in the United States. And so what happened is their key non-GAAP metric used to be adjusted EBITDA, all right? And then in 2014, they suddenly changed from adjusted EBITDA to adjusted cash EBITDA, all right? So what did they really do? They essentially started to add deferred revenue towards their EBITDA. Okay, and so of course that served to increase EBITDA in 2014. So you could see, had they made the change in their non-GAAP metric in 2012, because the overall change in deferred revenue was net negative, it wouldn't have helped them. In 2013, it would have been a wash, so why change the metric? In 2014, there was this big increase in deferred revenue, okay? So once you add that, suddenly your adjusted cash EBITDA skyrockets, goes high, okay? And what's interesting is the stock reacted very positively, and in fact, after they changed to this metric, by the middle of 2015, the stock reached all-time high and then dropped, literally within another year or two, it dropped 60% of its value. Because this is the product of accounting innovation that is not sustainable. And so, of course, one of the problems with doing that, when you add deferred revenue, is what happens. So a lot of this deferred revenue, the actual, there's going to be mismatch between revenue and expense in the first place. And the other thing that happens is that when they just add deferred revenue, they don't take into account the related costs. So that means if there are deferred revenues that they added, $220 million, would have been revenue, right? There is that implies that revenue bears 100% profit margin, which is of course not the case, right? So on so many ways, this is what's wrong with non-GAAP metrics. Now, and of course, one other thing that propagates, if you will, the use of non-GAAP metrics is that a lot of companies are doing that, okay? And this is not to say that all of the non-GAAP metrics are bad. That's far from what I'm saying. But the degree of reliance and the degree of promotion of non-GAAP metrics by companies have increased massively since Regulation G was adopted in the United States by the Securities and Exchange Commission back in 2004. And so you could see the use of, so what this chart tells you is it gives you the percentage of companies, S&P TSX 60 here in Canada and S&P 500, largest 500 companies in the US, for whom consensus earnings numbers are based on the non-GAAP earnings, okay? So you could see in Canada it's around 80% of companies. In the United States it's around 65%. So in Canada the use of non-GAAP is even more prevalent than in the United States. And so we did a comprehensive study looking at S&P TSX 60 companies in 2015, and we're going to publish an update to that report shortly. And what we found is, perhaps unsurprisingly, is that if you take the non-GAAP numbers that companies provide, and so let's say, for example, you take net income, okay, and compare that to GAAP net income, so all the adjustments will be positive, and the non-GAAP result for the companies taken together will be roughly 16% higher than GAAP, okay? Now, and that's for non-resource companies, and for resource company it will be substantially more because they had a lot of impairments. Okay, and then EBITDA, same thing with EBITDA. If you just take standard EBITDA being earnings before interest, taxes, depreciation, and amortization, okay, but of course a lot of companies do adjusted EBITDA, so adjusted EBITDA will be higher than normal EBITDA by at least 9% for the non-resource companies and by 100% for resource companies. And so, as I mentioned, the reason for these discrepancies where non-GAAP metrics are invariably higher than GAAP metrics or unadjusted metrics is because over 80% of the adjustments are favorable. Okay? And so now, the important question to consider is if earnings are inflated, well, what about the valuations? Right? So if management can convince sufficient number of investors and analysts that the non-GAAP number is the right number, then it becomes the right number, and then markets believe in that number. And so And it can take a meaningful amount of time until market starts doubting that number. For example, that's exactly what happened with Valiant. Throughout their histories, they've been rising in share price. The key point, the whole story was supported by non-GAAP metric because they failed to generate a penny in free cash flow. They failed to generate a cent in GAAP net income. So what do you do, right? Because you still got to promote the story, so you put all these nice non-GAAP metrics. Now, the other important point, and that obviously affects valuation. The other thing important to notice is that based on our study, roughly 35% of S&P TSX 60 companies had not adhered to the CSA Staff Notice 52306, which is the guidance for how non-GAAP metrics should be disclosed, prepared, and presented. Okay, and there's been a number of different there's been a number of different violations, and we don't expect that number to decline. So what are the types of adjustments that we commonly see that companies add back when they calculate their non-GAAP earnings or EBITDA or whatever the metric might be? So it is, of course, amortization and depreciation, impairments, because who cares about impairments? It's past, right? Deferred taxes, that's definitely you don't need to care about that because only accountants care about that. And then there is share-based compensation, but it's non-cash, so who cares too, right? And so now, the problem, of course, is that if management claims that expense is non-cash, then what are accountants counting, okay? And what was management spending back in the day then? So let's look at some of the examples from, again, this is all from the companies that we have been covering and writing about. So this is Concordia International. So it's a roll-up story. They've been buying, it's a pharmaceutical company. They've been buying other companies that would have old drugs. They would do very little research and development. They will buy those drugs, raise the price on those drugs tenfold, and make money on that. And so they would generate negative organic revenue growth rate. And of course, because they don't do any R&D, in reality, their real R&D is the cost of the acquisitions, right? Therefore, it's the intangibles that they acquire, which are the patents, right? That they buy, and those drugs, you have a finite patent, right? That expires after 5 or 10 years, right? And so clearly, when you're buying those assets, you need to replenish them if you want to maintain your earnings. This is not some kind of asset that is there and it could last forever. And so, if you want to calculate sustainable level of adjusted net income, and a proxy for research and development costs for them to maintain their existing revenue and their existing profits, then maybe amortization should be considered as part of adjusted net income. So they, of course, excluded it, but that might not necessarily be the best adjustment to make. In other words, it misrepresents the sustainable level of earnings that that particular company generates. Okay? Now, what about stock-based compensation? So, of course, if company doesn't, part of the compensation is in stock, right? So if you don't pay your employees in shares, then you got to pay them in cash, right? So it's just a substitute of a compensation cost. So why that should be ignored? Here's an interesting example. McDonnell, Detweiler and Associates. So they do satellites. Very good company, actually. They built the Canadarm, by the way. So great people, except the only, in terms of their non-GAAP accounting, one of the problems is big chunk of their compensation is stock appreciation rights, and I guess you could probably figure by now, given all the context that I was giving, that they have been excluding it from their key non-GAAP metric, and that is operating earnings. It's interesting that their competitors would include stock-based compensation in their operating earnings, such that, now oftentimes what happens, investors would run a whole bunch of screens. So how does the company screen on price to earnings basis, okay, or EV/EBITDA basis? And of course, if your EBITDA or if your earnings exclude a significant proportion of costs when the other guys actually include it, so the stock would seem cheaper than it really is, right? And so now, I think what made matters worse in their case is that it was actually cash settled stock appreciation, right? So it was actual cash out of the door, and they would still exclude it. And of course, had that been included in their non-GAAP metric, it would have been 20% lower on average. All right. Another common add back is impairments. Okay. Now, and the problem with impairments is that this is real loss. in more often than not, unless you are in the resource sector, which sometimes could reverse. And capital misallocation, unfortunately, happens quite often. Okay, and excluding that from valuation may yield inflated values for the companies. And so what are some of the considerations that we use and we recommend other investors to consider when they see asset impairments? And whether they should be incorporating that into their models by, for example, increasing the discount rate or assuming lower rate of return in the future. So are the people who approve the assets are still in place, and who approve the asset deal are still in place, and most often they are. You know, what was the company's track record? Has the company produced returns on a GAAP basis that exceeded the cost of capital? Is impairment due to volatile economics of the industry, and therefore is it potentially temporary in nature? So all those questions investors have to ask themselves when they considering companies' adjustments. And unfortunately, what happens is we oftentimes get so. We have to run through the process because we end up covering so many companies that you just want to get one easy number and use it, plug into a valuation model, slam a multiple on this, and go. Here is another example, and this is non-recurring expenses, which most often companies would exclude restructuring costs. Why? Because they are unusual, they are non-recurring, etc. Now here is Bell Canada, and the beauty is that they had restructuring costs in every year over the past 5 years up to 2015. Okay. Now, and it's interesting. They say when they describe their non-GAAP metrics is we use adjusted EBITDA and adjusted EBITDA margin to evaluate the performance of our businesses as they reflect their ongoing profitability. Because of course, you know, the $400 million that you spend on severance, that's not part of ongoing profitability. And so the question is if a company incurs expense every 5 years, is that not part of ongoing profitability? We'd argue that it is, right? And so there is no reason that should be excluded. Okay, so there is of course a list of considerations that we as investors need to think about when we decide whether to include it or exclude it, and whether we should incorporate it into future, into our valuation models. But of course, if it's something that has been persistent, then there's no reason why that type of charge should be continuously excluded. What about other KPIs? So now we spoke about the ones that are directly used in valuation. But there are some other things like same-store sales growth. Well, it also affect valuation, obviously, but this is more of a top-line result rather than bottom line. So same-store sales growth is one of the key metrics that retailers are presenting to investors. And so, as you could see on this slide, we've compared how retailers calculate same-store sales growth. And what perhaps unsurprisingly, what we found is that there's no even common definition there. So they calculate it differently. There is inconsistencies between companies. Some companies don't even explain how they calculate same-store sales metric, like Metro, for example. Okay, some companies include remodeled or expanded stores. Some exclude them from their calculation. All right. Some companies don't say whether they include certain digital sales or not. So as you could see, one of the problems that we run into when analyzing non-GAAP metrics is because they're not comparable really. Okay, and they can be called the same, but companies end up calculating them differently because there's no uniform set of rules how they should be calculated. And that creates all sorts of anomalies and valuation anomalies as well. And so another example is for mining companies, all-in sustaining costs, a very important measure that investors are looking at. And there is a standard, it's not really a guidance, but it's a framework how this should be calculated, okay, put out by World Gold Council. That says here is what companies should include as part of the all-in sustaining cost. Here is what they should not include. And what we found that in practice companies do it inconsistently, and they make a whole lot of different adjustments that make their reported all-in sustaining costs look better, that is, look smaller. okay? Because you want to have your costs minimized. And so some of the examples, Agnico, IAMGOLD, and Yamana. So if we were to normalize the way that they calculate their all-in sustaining costs and put it on the same basis, for example, as Barrick Gold does it, and as the World Gold Council suggested in their guidance, then their all-in sustaining cash costs will be 10% higher, 3% higher, and 4% higher, respectively. And of course, these types of things definitely affect the valuation, right? So, very important to consider. The other adjustment that is very common is and it's of course very prevalent in REITs when they calculate AFFO metric. It's also prevalent for companies that calculate free cash flow and provide that number to investor, the free cash flow. So the idea is to exclude, you take some kind of operating earnings or operating cash flow number and you deduct from it maintenance capex or sustaining capex, which is in other words reinvestment that you need to put into the business in order to maintain existing level of cash flows or operating earnings. And so what we find, unfortunately, too often is this number that is the provision for maintenance capex is understated, or at least we believe that it is understated. And so, and this is real life, real drama, CapREIT. And so you could see that they have determined that their maintenance capex was 15 million in 2014, 15 million in 2013. Then, if you go and look in their management discussion and analysis, they break out all sorts of capex that they have incurred, and that enables the users to make a judgment on whether the 15 million that they actually say is their maintenance capex, whether it is close to that or not. And so you could see here that some of the items, they are clearly gross capex, so not part of the maintenance capex, like building improvements, suite improvements, energy saving initiatives. And then you're left with common area, equipment, boilers and elevators, and appliances. So the amounts that they spend on those during a given year. And so when we spoke to them about what's included in common areas. So what we found is, well, common areas include renovating the lobby. So when they're painting the staircase as well, that will be included in common area. And guess what? Most of it is gross. Why? Because it beautifies the buildings. It enables them, according to to the explanation, to charge higher rent. Same thing with equipment, all right? So what is equipment? Equipment is carpets that they buy, okay, to essentially replace carpets in the units, okay? So, please, 5 minutes. I'm almost there. Okay? So, long story short, same thing happens with the elevators. So if they replace an elevator, a big chunk of that goes into gross capex. I mean, good luck trying to rent out a building without an elevator. And they're also competing with condominiums, right? So, I mean, if you don't paint your lobby, it's hard to see how you can continue maintaining even existing rent. So the point is that maintenance capex that companies are reporting generally tend to understate the actual sustaining capex. All right. So here is some points to consider when evaluating non-GAAP metrics. And one of the important points is to actually understand what the market is using and how it is calculated, and when the market will start caring about that metric. Because a company can go for a long period of time using all sorts of misleading metrics, and then operations start deteriorating because you run out of accounting tricks, okay? And then everything starts to matter. And when it matters big. So, and of course, to consider whether adjustments make common business sense, and there is a number of others, so I'll leave you with that. And then some advice for users is, of course, don't blindly accept non-GAAP metrics, okay? Scrutinize adjustments. Compare valuation and performance metrics using both GAAP and non-GAAP measures. And you could see that companies on a GAAP basis could be generating much lower and consistently much lower than on non-GAAP basis. And sometimes it makes sense, sometimes it doesn't. Okay, some recommendations for regulators. So issue a detailed guidance. So we have a very general guidance how non-GAAP metrics should be prepared. Okay, so the United States, for example, SEC came out with compliance and disclosure interpretation that answers a whole host of very specific questions that takes that answers questions how to deal with deferred taxes, how to deal with capex, how to deal with a whole bunch of other adjustments. So it provides greater clarity for companies. and greater standardization as well, all right? The other thing is consider explicitly prohibiting certain adjustments. For example, if restructuring cost has been there and incurred by a company over the past 2 years or 3 years, then maybe that shouldn't be excluded, all right? So things like that. Or, ensure that stock-based compensation is no longer excluded as irrelevant, okay? Make sure that that companies and actually police the compliance with whatever is already in place, and make sure that companies clearly present all the adjustments and explain the rationale for those adjustments. One of the things that we find is that you'll see reconciliation non-GAAP to GAAP, and then there is a number of adjustments, but company doesn't explain why they believe it's appropriate to make those adjustments, okay? And of course, audit compliance with regulatory standards. And then how audit could help. And so one of the things that's going on is that there is misperception by investors in that they believe that if financial statements are audited, therefore somehow non-GAAP metric also makes sense and is kind of the right number. And this is not, of course, the purpose of the audit, all right? Also, the numbers in the MD&A and management discussion and analysis, the auditors don't audit that, right? They just need to look at that and see if it's consistent, if the numbers there are consistent with financial statements, right? So it doesn't give you a whole lot of assurance, all right? One of the things that will be really helpful for investors, for example, if auditors were to audit the compliance with compensation programs. So oftentimes you'll see in the management information circular that management is evaluated based on EBITDA or whatever, cash EPS, etc., and attaining certain targets. But what will be interesting to see if there is an audit that actually vouches that this is in fact how CEO is compensated and the company is adhering to its own compensation programs. Okay, and so these are the things that I will leave you with, and I think I probably ran out of my time by now, but that's pretty much what I wanted to cover.
Thank you.
Thank you.
And while you're there, we'll give the group a chance to ask some questions, and
Sure.
then we'll move to the last session. Are there questions for Dimitry?
Yes.
Why isn't there greater investor activism with that while this is happening?
So,
What's your view of that?
sure, I think the fundamental problem is that if you are a fund manager and you're dealing with 90 stocks that you need to cover, you're really busy. And so if you want to go start and being involved, you need to spend time. So it's really just time commitment. That's the biggest one. That's number one. And number two, there is a belief out there that we can make our we can express our opinion, but it's far from certain that it will end up being incorporated. So these are the two factors that I see all the time by dealing with my clients.
Dushan?
They worry a lot about their own performance and how the stocks are doing, and so trying to immerse themselves into understanding a new accounting guidance and how that will affect financial statements, or trying to lobby, which takes a lot of time, is something they're not willing to spend a lot of time on, unfortunately.
Dushan?
So on the specific stocks that you issued reports on, and this follows up on the previous question actually. Why is it that the investors are willing to listen to the management and to other non-independent analysts and not listen to? Why does it take so much time for your message to disseminate properly? And let's take the case of value.
Why it took so long? Yeah. Well, so there is a combination of factors. So one of the things that happen that investors consider is whether some big name hedge funds are invested in the stock or some high profile investors are invested in the stock. And so, for example, in Valiant's case, the who is who of the hedge funds world was invested in that stock. People with great track record. And so that was a very significant factor. The other thing is, it can take time. So let's say Valiant was running an acquisition roll-up story. You keep buying companies. And you can do that quite successfully for a meaningful period of time until you start running out of targets, because you get to a certain size that to start to move a needle, you got to make bigger and bigger acquisitions, and eventually you screw one of those. And so there is this run rate where the stock could go up despite having this bad financial metrics, because investors, even those who understand that the metric that they're providing is not extremely good and that have concerns with management, they are willing to stay in there, because ultimately, remember, you're evaluated as an investor, especially with the large funds, you evaluate it against the index. And so if S&P TSX 60 went up 2% during the quarter, and the big component of that 2% increase was because Valiant increased 15% in price during the quarter, and you didn't own that, you get problems, right? So your bonus goes down, etc. And then consultants come to you and ask you, well, how come you don't own Valiant? Look at the track record, right? So all of that pressure takes place. And then the other thing, as I mentioned, the story oftentimes is extremely powerful. And a lot of investment happens not on the basis of financial statements, but on the basis of the press releases and on the basis of management telling very exciting story. So the story with Valiant was, we are the guys who are going to revolutionize the entire healthcare industry. Why? Because we're going to drop all that BS that the pharmaceutical companies are doing, like spending on R&D, because it's it's funny, but it's true, which brings tears to my eye. But the chart that Valiant used to illustrate the story is, you look at the returns on R&D over time, and they have been declining, and they have been declining big. So there is always, every story, there is always a component of truth to it. Right, and that component of truth takes over a whole bunch of other reasons. And then look, I can tell you even as far back. So back at the end of 2014, I went to New York to meet some of the large hedge funds who were invested in Valiant and try to persuade them to divest. And the point I gave them essentially is, look, don't trust management, because they're telling a whole bunch of inconsistent things that don't check out. You speak to former employees, you don't get a good feel for this company. Anyways, I can go on and on and on. And the response that I got was, you know what, it's all good, but it doesn't matter. Why? Because Bausch & Lomb, which was one of their acquisitions, they will outperform. And so now what ended up happening is really Bausch & Lomb ended up not mattering at all. And it was actually management credibility that sunk the company, because they were doing a whole lot of things that were borderline illegal. And so oftentimes investors would ignore things that you see in financial statements, things that you see in all other disclosures and inconsistencies, and they will ignore the skeptics. Because they pick a certain element out of the story that they overweight. And then it becomes an argument about what might happen into the future, which I have no idea, right? And which nobody knows what will happen, versus what we see in the past. Sorry if it was a long answer.
We have time for just one more, Kareem.
I guess one question arises: how many times are you wrong when you accuse somebody of being bad? How many other people are out there accusing people of being bad? How thorough are they in their analysis? Are they just trying to drive the price down, so they just throw mud at somebody and try and drive the price down, and then they run off and say that nothing's wrong? And if that's the nature of the marketplace, and there's all kinds of noise, then it becomes difficult for the market to kind of sort out. When you throw mud at somebody, have you really done a thorough analysis, and are you correct, or are you wrong this time, or are you one of those guys just throws mud at everybody and runs off? And there are studies in Journal of Business Ethics, for example, showing that people make false negative accusations against companies. And that drives the price of those companies down, and then they sell, make a big amount of money, and they just run away.
Very valid point.
It takes good companies a long time to recover. Because all this mud's been thrown at them, and there are all kinds of people who profit from them. So
Definitely.
maybe they should regulate you. It's people like you there's actually a whole army of people like you going around throwing money at all kinds of people and making money out of it. And actually there's no basis to that money. Right?
Okay. No.
Actually a very large number of folks.
You got several questions all wrapped up
This is
there.
a broader notion of noise in the marketplace, right? There's all
Sure.
kinds of people-
Yeah. So let me. Yeah. And please remind me because there is a number of questions. So I might in case I forget some of them. So the first point. So we don't short and we don't long any of the stocks that we publish. We don't profit. So our company Veritas, we don't profit whatsoever from our calls. The only thing that we make money on is we sell research to our clients who are institutional funds, and they pay us certain fixed amounts per year, and also based on how their funds are performing.
But you could still be wrong. So
Definitely, I can still be
that
wrong.
would be an interesting thing to show how often you're wrong
Sure.
in accusing people of being bad.
Yeah. So, okay, yeah, definitely. So we've been wrong, for example, on CGI, a company, a large Canadian company, where they made an acquisition and they did a whole bunch of acquisition accounting adjustments, which increased their EBT reported going forward. Now, and that's fact, it did increase. What we did miss there is, as they were reporting higher earnings, that was done through accounting adjustments at the time of the purchase price allocation, because you fair value the contracts and you can take certain losses ahead of time, etc. So what we did miss is we missed that they are renegotiating the contracts at a much more favorable rate than the company that they acquired, and so that happens. Having said that, so I can tell you from my personal experience, here are the companies that I have been covering, and so. SNC Lavalin, and so I covered them, and that was right before they exploded with bribery and with inappropriate revenue recognition, and one of the issues that we've been raising was about revenue recognition, okay? Garda, they are no longer public, but it used to be a roll-up story, and they've been buying companies, and they made, and they had a whole lot of, here is a good example. So for example, they acquired a company, and then they came in and they changed lease classification. That company used to account for it as an operating lease. What happens with operating lease? It reduces EBITDA. This company was all evaluated on EBITDA. They changed it into capital lease, right? Suddenly EBITDA is much higher. So overall, I think when we come out, one of the things that really scares us is we can actually get sued by the companies, all right, if we're throwing mud at them. And so that is why when we come out and we, as you say, throw mud, I would disagree with you saying that this is mud. What we are doing is we're pointing out facts, and then we are interpreting what those facts are. And this is very different from throwing mud that is unsubstantiated. And we have been both sued in the past, and we have received legal letters in the past, and we have gone through all of that and been doing that since 1999. And one of our first calls was Nortel, where we were the only ones saying sell that stock, and we lost clients, and we've been called unpatriotic and a whole bunch of things. And so what really, I think, keeps us in line is the risk of us going out of business, because we end up dealing with companies, so large multi-billion-dollar companies. So if we get our facts wrong, and if we start throwing mud, believe me, we would have been out of business a very long time.
I think what we're going to do is stop it there. I know this could go on quite some time. But I want to say, Dimitry, it has been, I think, certainly revelatory to see what you are doing and to hear about it. And we certainly know what Muddy Waters was all about. And yes, there are some people that benefit from the noise. But on the whole, you and others are doing some very good work. Not that it's negative with regard to Gaap, but we are seeing once again that Gaap is not carrying the day, that there's something missing.
Yeah.
There's a vacuum there. The corporations are using that open space to do things perhaps they shouldn't.
Yeah. And the other thing is the overall cheerleading environment on the sales side. And so when you have an environment of cheerleading, I don't think it's necessarily bad to have somebody who takes a skeptical view and tries to actually assess the story. And in fact, roughly half of our recommendations are buys. So we have we don't have holds because I don't know what it means really, right? And I don't know what market perform means. So we have either buy or we have a sell. And so roughly it changes. Sometimes it's 40, 60, etc. But it's around 50-50 buys and sells. So so if we if we test the story and it comes out to be true, and we talk to former employees, suppliers, you name it, we'll write a buy. We don't have any problem with writing buys.
Very good. Can you join me in thanking our speaker?
Thank you.
Thank you very much, and we have a gift.
Thank you,
for
Len.